Want to invest in a world-class business that is firing on all cylinders? Interested in a market-beating dividend that recently got increased by nearly 50%? Looking for undervaluation on a high-quality dividend growth stock after it's dropped by 25%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is the world's largest package delivery company. We've got nearly 8 billion people on this planet now, and a lot of these people are consumers. What do consumers do? Well, they consume, and that involves a lot of transportation and delivery of goods to be consumed. As the world's largest package delivery company, this company is getting a piece of all of that action. The action, by the way, is growing, and that is leading to increasing revenue and profit, as well as a growing dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of United Parcel Service Inc., which appear to be trading at a significant discount today. United Parcel Service Inc., stock ticker UPS, is a multinational shipping and receiving and supply chain management company. Founded in 1907, UPS is now a $150 billion by market cap shipping juggernaut that employs 400,000 people. The company reports results across 3 segments: U.S. domestic, 62% of fiscal year 2021 revenue, international, 20%, and supply chain solutions, 18%. This is the world's largest package delivery company. UPS uses nearly 600 planes and more than 100,000 vehicles to deliver millions of packages to residences and businesses worldwide every single day. US operates a simple to understand business model with a very straightforward long-term investment thesis, and this thesis involves a high degree of confidence. The world is full of consumers. Naturally, they consume a lot of stuff. Well, UPS is there to logistically make sure that stuff gets properly transported so that it can be consumed. It's as simple as that. However, the simplicity makes it no less attractive. If anything, it's the opposite. This is a fantastic business, and it's becoming more fantastic by the day. That's because UPS has 2 powerful and enduring tailwinds blowing their way. First, global consumption is growing. This is the result of a huge global population, nearly 8 billion people, that is increasing in size while simultaneously becoming wealthier. Second, more goods are being shipped directly to consumers after online purchases. Because of the meteoric rise of e-commerce over the last decade, demand for point-to-point shipping has also dramatically risen. As the world's largest package delivery company, that plays right into the company's hands. That should lead to UPS being able to continue growing its revenue, profit, and dividend for decades into the future. UPS has already increased its dividend for 13 consecutive years. The 10-year dividend growth rate is 7%. That's not bad, especially considering the stock's market-smashing yield of 3.5%. That yield, by the way, is 70 basis points higher than its own 5-year average. There's nothing wrong with that combination of yield and growth. However, it's actually better than it looks. That's because recent dividend growth has accelerated, with the most recent dividend increase coming in at a jaw-dropping 49%. Even after that big move with the dividend, the payout ratio is still 49.7%. That's nearly a perfect payout ratio, harmoniously balancing retaining earnings for internal growth against returning cash to shareholders. I like dividend growth stocks in what I refer to as the sweet spot. That's the yield of between 2.5% and 3.5% paired with a high single digit or better dividend growth rate. UPS ticks both the yield and growth boxes here, making it very sweet. Looking at business growth, UPS advanced its revenue from $54.1 billion in fiscal year 2012 to $97.3 billion in fiscal year 2021. That's a compound annual growth rate of 6.7%. Strong top-line growth here. I usually look for a mid-single digit top-line growth rate from a large mature business like this. UPS more than delivered. Meanwhile, earnings per share moved up from 83 cents to $12.13 adjusted over this period, which is a compound annual growth rate of 34.7%. Huge EPS growth. 3 quick caveats. 1, fiscal year 2012 earnings per share was abnormally low. This lower starting base skews the growth rate higher than it ought to be. 2, I used adjusted earnings per share for fiscal year 2021. This is actually lower than GAAP earnings per share as UPS recognized an MTM pension gain on a GAAP basis for fiscal year 2021. Using GAAP earnings per share would have led to an even higher 10-year compound annual growth rate, but that would have also been less accurate. 3, the pandemic undoubtedly helped the company. Growth went into overdrive over the last 2 years. No matter how you slice it though, UPS has put up some great results. Helping to propel a lot of this excess bottom line growth has been a combination of slight margin expansion and share buybacks. Regarding the latter, the outstanding share count is down by approximately 9% over the last 10 years. Looking forward, CFRA believes that UPS will compound its earnings per share at an annual rate of 8% over the next 3 years. This would represent a major drop from the 34% plus compound annual growth rate UPS put up over the last 10 years. However, I don't see it as off base at all. As I just pointed out, we have to look at the 10-year EPS compound annual growth rate with caveats. The difference between top line and bottom line growth in this case is very stark, and I explained why. On the other hand, it's unlikely for such a large delta to persist. If we assume that revenue growth will remain in that high single digit range, it would be reasonable to expect earnings per share growth to come in pretty close to where CFRA is at here. Buybacks alone could get you there, and further margin expansion aided by increasing automation at facilities could also help. UPS would then be able to grow the dividend at a like rate for the foreseeable future, and pairing that 8% or so dividend growth with a starting yield of 3.5% is a rather compelling combination of yield and growth in my view. Moving over to the balance sheet, UPS has a rock-solid financial position. The long-term debt-to-equity ratio is 1.4, while the interest coverage ratio is approximately 25. It's due to low common equity, not an inordinate amount of debt, that the debt-to-equity ratio looks somewhat high. Profitability is fairly robust. Over the last 5 years, the firm has averaged annual net margin of 6.8% and annual return on equity of 192.2%. Return on equity is obviously so high because of the low common equity I just touched on. Net margin, however, could be higher. Signs of improvement have shown up over the last few years, and I think increasing automation will boost this metric further. UPS has a terrific business that is positioned to benefit and profit from rising global consumerism, and the company does have durable competitive advantages that include massive economies of scale, an established global network, cost efficiency, and high barriers to entry. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Competition is heating up with Amazon.com Inc., stock ticker AMZN, building out a delivery network and insourcing logistics. This could hurt UPS doubly so, as Amazon is a large customer for UPS, accounting for more than 10% of annual revenue. It's possible that a recession is on the horizon. Such an event would temporarily reduce demand for goods and shipping, which would impact UPS. The global supply chain is currently in a state of flux. Soaring fuel costs are an issue. However, UPS does effectively hedge fuel price fluctuations with fuel surcharges. Escalating labor costs are another risk. I believe investors should carefully consider these risks, but I also think UPS can and should make for an excellent long-term investment. With the stock down 25% from its recent high, creating what looks like an attractive valuation, I believe it could be a particularly excellent long-term investment right now. The stock is trading hands for a price-earnings ratio of 14.2. That's well below the broader market's earnings multiple. It's also way off of the stock's own 5-year average PE ratio of 26.7. But lumpy GAAP earnings per share skews this. If we look at the cash flow multiple, which has been less lumpy, it's currently at 10.2. That's much lower than its own 5-year average of 15.4. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This number is far below both the long-term demonstrated earnings per share growth rate and near-term earnings per share growth forecast. It's also right in line with the proven 10-year dividend growth rate. And with the payout ratio remaining almost perfectly balanced, I expect future dividend growth to roughly mirror EPS growth. I don't think this is a high hurdle for UPS to clear when we look out over the long run. If anything, there's a nice margin of safety here. The dividend discount model analysis gives me a fair value of $216.85. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates UPS as a 3-star stock with a fair value estimate of $186. CFRA rates UPS as a 4-star buy with a 12-month target price of $240. I came out almost exactly in the middle. Averaging the three numbers out gives us a final valuation of $214.28, which would indicate the stock is possibly 23% undervalued. Here's the bottom line, guys. United Parcel Service Inc. is a high-quality business that's advantageously positioned in a world with rising consumption and point-to-point delivery. Logistics are only becoming more important to everyday life. With a market-smashing yield, 13 consecutive years of dividend increases, a recent dividend raise of nearly 50%, a balanced payout ratio, and the potential that shares are 23% undervalued, long-term dividend growth investors would be wise to consider shipping this stock into their portfolios. And now for a special news announcement. Williams-Sonoma Inc., stock ticker WSM, just printed a blowout Q1 report, easily beating on both the top line and bottom line. We recently covered this world-class home furnishings company, highlighting it as a deeply undervalued idea. This earnings report could send the stock soaring. If you don't yet have this wonderful business in your portfolio, now would be a great time to think about changing that. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.